$500,000 doesn't run out because you spend too much. It runs out because you're playing a game where the rules changed mid-match and nobody handed you the updated rulebook. The 4% rule, the single most cited piece of retirement math in American personal finance, was calculated using bond yields that haven't existed since the 90s, an average retiree lifespan that ends at 78, and a healthcare cost model that predates the Affordable Care Act. You are using a map drawn for a different city. And it gets worse. Because the specific moment the market decides to have a bad year matters more than your total account balance. Retire into a bear market, and $500,000 can behave like $350,000. I'll show you exactly how that math works in a few minutes and why it's the kind of thing that doesn't appear in the retirement calculator your brokerage gives you for free. What I want to do in this video is walk through 4 layers of risk quietly embedded in a $500,000 retirement risks that compound each other in ways that standard planning completely ignores. By the end, you'll understand why the number on your brokerage statement is almost a distraction from what actually determines whether your retirement holds. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard methodology to expose the weak points in your specific plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link is in the description. Now, here's a metaphor I'm going to use throughout this video, because it makes the math intuitive in a way that spreadsheets don't. Your retirement savings is a reservoir. You've spent 30 years filling it. And the question everyone asks, including financial advisors, including retirement calculators, including every listicle ever written about retirement is the reservoir full enough? 500,000, is that enough water? That's the entire conversation. But nobody asks, how fast is it draining? What's the temperature of the water? Does the dam have cracks you can't see from the surface? And what happens if the first summer after you stop filling it turns out to be the hottest in recorded history? The reservoir is going to keep coming back as a frame because it explains something critical. You can have a full reservoir and still run dry. The failure isn't in how much you saved. The failure is in the physics of the system the water is sitting in. Check the dam. In a few minutes, I'm going to show you a specific chain reaction that turns a perfectly respectable $500,000 retirement into a structural emergency by year 5. But first, here's why the foundation under that number is more cracked than most people realize. In 2023, Morningstar published research showing that the safe withdrawal rate for a 30-year retirement starting in today's environment, meaning today's bond yields, today's equity valuations, today's inflation baseline, was not 4%. It was 3.3%. That's the number that actually keeps you solvent across 90% of historical scenarios. And I know 3.3 versus 4 doesn't sound dramatic, but run that through $500,000. 4% of 500,000 is $20,000 a year. 3.3% of 500,000 is $16,500 a year. That's a $3,500 annual gap. Over 30 years, adjusted for compounding the money you don't draw, is money that keeps growing. That gap represents roughly $110,000 in reduced lifetime income. More importantly, it represents the difference between your reservoir holding through a rough stretch versus going dry in year 23 when you're 85, and your options are limited. The 4% rule was introduced by a financial planner named Bill Bengen in 1994. He backtested it against 50 years of market history. Solid work at the time. But the original version assumed a 60% stock, 40% bond portfolio. In 1994, a 10-year treasury bond yielded around 7.8%. In early 2026, it yields roughly 4.3%. That's not a minor input change. Bonds are a shock absorber in your retirement portfolio. When the shock absorber is half as effective, the whole vehicle handles differently on a rough road. The rule was calibrated for a world where bonds paid real returns. That world is gone. And here's where people make the classic error. They see bonds yielding 4% and think, well, 4%, that's basically matching the withdrawal rate. We're fine. But the withdrawal rate is a drain. The bond yield is a fill. They are not the same direction of flow. When the fill rate and the drain rate are roughly equal, you're not growing, you're treading water. and you're treading water while inflation quietly raises the cost of everything around you. Speaking of inflation, the commonly cited figure is 3% average annual, but that number hides something important. Healthcare inflation in the United States has historically run at 5.5 to 6% per year, almost double the general rate. And healthcare is the single largest discretionary expenditure for people between 60 and 75. So your retirement budget has a structural imbalance baked in. The part that grows fastest is the part that costs the most. Now, the reason I want to stop here for a second, financial advisors are aware of this math. They know about the 3.3% figure, they know about healthcare inflation, and yet, when you sit across from one of them and they run your retirement projection, they almost universally use 4% and a blended 3% inflation assumption. Why? Because their business model is built on managing your assets, not on telling you something that might delay your retirement and reduce the assets they manage. I find this more absurd than sinister. It's not a conspiracy. It's just incentives working exactly as designed. This is where it gets really interesting. And stay with me, because this next part changes the math in a way I haven't seen discussed clearly anywhere. The average American man turning 65 today can expect to live to 84.3 years. The average woman to 86.7, but those are averages across the whole population. If you are in the top half of health outcomes at 65, meaning you exercised, maintained weight, had regular checkups, avoided physically destructive work, your life expectancy pushes closer to 91. And the people who retire with $500,000 tend to be exactly that demographic. They were employed in knowledge work or management. They had employer health insurance. They had the income to maintain their health. So the $500,000 retiree has the highest probability of needing that money to last the longest. Run the 3.3% withdrawal rate over 33 years instead of 25. And you don't run out in year 33. You run out in year 29. The distribution tail, the years you weren't planning for, is exactly the time you're most expensive as a human being. The traditional retirement model was calibrated on a median retirement duration of 18 years. Retire at 65, die at 83. That is not the median outcome for a healthy 62-year-old in 2026. 30 years isn't a pessimistic estimate. It's the median. Now, something I want to flag before moving forward. Everything I've described so far, the broken withdrawal rate, the bond yield problem, the longevity extension, these are real and they compound each other. But they're also slow. They unfold over decades. The next risk I want to walk through is not slow. It can destroy a retirement in the first 24 months. And this is the one that catches people completely off guard. There's a man I want to tell you about. He's a composite of multiple case studies. And if you've talked to a financial planner for more than 20 minutes, you've met someone like him. Call him Ray. Ray retired in 2007, 58 years old. Had done everything right by the standards of his time. Maxed his 401k for 20 years, had about $480,000 saved. His financial advisor ran the numbers, showed him a Monte Carlo simulation with a 92% success rate, and told him he was in excellent shape. Ray believed it. 6 months after Ray stopped working, the S&P 500 began its decline. By March of 2009, it had fallen 57% from its peak. Ray's $480,000 had become roughly $210,000. But here's what makes this story mathematically brutal, rather than emotionally sad. Ray was drawing from that portfolio the entire time, because he had to eat. His withdrawal amount was a fixed dollar figure, not a fixed percentage. So as the portfolio shrank, the percentage he was drawing exploded. He was pulling the equivalent of 9% of his portfolio in year 2. No reservoir survives that drain rate. Ray went back to work at 62, not because he wanted to, because the dam cracked in the first season after he stopped filling it and the water was gone. This is what sequence of returns risk actually looks like. Not a chart, a person. The mathematics work like this. Take 2 investors, identical portfolios, $500,000 each. One gets strong market returns in the first 5 years of retirement, weak in the last 5. The other gets weak first, strong last. Over the full 30 years, both average 7% annually. The sequence was the only variable. The investor who got bad returns in the first 5 years runs out of money in year 27. The investor who got good returns first dies wealthy. Same money, same average, different sequence. Completely different outcome. Think about what this means for your reservoir. The water level in year 1 and year 2 of retirement matters more than the total amount you filled it with. If the dam breaks in the first summer, the reservoir doesn't get to recover. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. And now here is where the video earns its title, because most of what I've described so far, you've encountered in some form. The next part, most people have not seriously modeled it. Knowing these numbers, the broken withdrawal rate, the sequence risk, the longevity extension, and building a real system around them are two very different things. Most people who research their retirement can identify the risks on a whiteboard. What they can't do is quantify the interactions between those risks. How a bad sequence in year 1 changes your optimal Social Security claiming age. How your healthcare cost profile changes your safe withdrawal rate. How behavioral drag compounds against a portfolio that was already thin. I built a digital book called The Exit Code. It's an analysis of 50 years of retirement data distilled into a mathematical framework for figuring out when you can actually leave the workforce without going back. It covers the dynamic withdrawal method, the approach that replaces the flat 4% rule with a rate that adjusts based on your portfolio's actual real-time performance and your remaining time horizon, which has historically extended portfolio longevity by 6 to 11 years in back-tested scenarios. It also covers the 58% rule, because if more than half of early retirees are forced out before their planned date, your margin calculations need to account for a runway that starts earlier than you expect. And it covers a Social Security bridge strategy. How to fund the gap between your retirement date and age 70 without drawing down principal, using a sequencing approach most advisors never model. All of it is built on actual data. It costs less than a dinner out through the link in the description below. Now, here's where I want to introduce someone specific, because concrete numbers do what abstract explanations can't. Gary is 61, project manager for a mid-sized manufacturing company in Ohio. 22 years in, he's done everything right by the conventional playbook, maxed his 401k for 15 years, has $520,000 saved, owns his house outright with roughly $200,000 in equity, carries no credit card debt. His company matches 6% of his salary, and he's contributed at the maximum the entire time. His HR department gave him a retirement planning booklet. It said he was on track for a comfortable retirement at 62. Gary has a bottle of scotch he's been saving. I'm going to come back to Gary at specific points in this video, because Gary's situation is about to teach us something the booklet didn't cover. And I want to hold that thread, because the resolution of Gary's story depends on what comes next. The number I want you to hold right now, $14,000. That is the average annual out-of-pocket healthcare cost for a 62-year-old American who retires before Medicare eligibility, which begins at 65. $14,000 per year per person. That figure comes from Kaiser Family Foundation analysis of marketplace insurance premiums and out-of-pocket costs for early retirees without employer coverage. And that is the average. If you have any recurring prescription or a manageable chronic condition, high blood pressure, type 2 diabetes, sleep apnea, you're looking at $18,000 to $22,000 annually. Gary's plan allocated 6% of his annual budget for healthcare. The actual figure is closer to 14% of his budget in a good year. This is a crack in the reservoir you cannot see from the surface. Let me do the math slowly, because it's worth sitting with. Gary retires at 62 with $500,000. The 36 months between 62 and 65 cost him between $42,000 and $66,000 in healthcare alone before he has touched his food budget, his housing costs, his utilities, his car insurance, or the dinner he had last Tuesday. That's 8 to 13% of his entire retirement savings consumed in the first 3 years, before the portfolio has had the chance to prove itself in either direction. And the timing is the trap. Those are the first 3 years of retirement, the exact window where sequence of returns risk is highest. Gary is drawing aggressively at the exact moment maximum vulnerability intersects with maximum uncertainty. Not because he's living extravagantly, because a 63-year-old cannot get Medicare and cannot afford to be uninsured. The system has designed a financial pressure point at precisely the wrong moment, and $500,000 walks directly into it. A healthcare advisor who doesn't make this visible to clients before their retirement date is not doing their job. An HR booklet that summarizes this as healthcare costs may be higher in retirement is not providing useful information. These are not minor omissions. This is the difference between a plan that works and a plan that fails in year 4. There is a related dimension to this that compounds the healthcare math significantly. And this is the thing I find most underreported in retirement coverage. The Employee Benefit Research Institute published research showing that 58% of retirees left the workforce earlier than they planned. Not earlier because they chose to. Earlier because something forced them out. A layoff, a health event, a caregiving responsibility, a company restructuring that eliminated their role. 58%. More than half of people currently planning a retirement date will not retire on that date. They will retire earlier with less savings and a longer runway to fund. This isn't a tail risk, it's the median experience. What this means for the $500,000 question is fundamental. You are not asking, is $500,000 enough if I execute my plan perfectly? You are asking, is $500,000 enough if there is a 58% chance I get pushed out 2 or 3 years early with less saved and a longer depletion horizon? That is a different question, and it has a different answer. Gary doesn't know this yet. He has a date circled on the calendar. He thinks his exit is voluntary. What Gary doesn't know is that his company is in the early stages of a restructuring that will eliminate the project management layer entirely in approximately 8 months. Gary's going to retire, not in 14 months, but in 8. Instead of $520,000, he'll leave with $490,000 because the final 8 months of contributions and match won't happen. He'll also leave 3 years before Medicare eligibility, with no employer coverage and a marketplace plan as his only option. None of this is in Gary's booklet. Now here's the layer that I think is genuinely underappreciated, even by people who already know about sequence risk and healthcare costs. It's the psychological tax. And it operates on a mechanism that most financial content doesn't engage with seriously. When you're accumulating wealth, working and contributing, you check your portfolio, and a good day feels good. A bad day feels bad. But then you go to work the next morning and deposit more. The accumulation phase is emotionally manageable because every paycheck is a vote of confidence in your direction of travel. The moment you start drawing down, the emotional math inverts entirely. Behavioral economics researcher Shlomo Benartzi has done some of the most careful work on this dynamic. He found that retirees who checked their portfolio monthly during a market downturn reported anxiety levels equivalent to clinical stress events. Not, I'm worried about money, anxiety, measurable physiological stress markers. And that anxiety caused them to make portfolio changes. Specifically, it caused them to sell, to move to cash, to protect what they had left, which is exactly the worst possible response to a market downturn when you're drawing from a portfolio. A Stanford Center on Longevity study from 2022 found that retirees who panic sold during the 2020 crash and re-entered the market 3 to 6 months later ended up with portfolios that were, on average, 23% smaller 5 years later than those who stayed fully invested. 23%. Not from market performance, from behavioral response to market performance. On a $500,000 starting balance, that's $115,000 in permanent portfolio impairment gone. Not because the market took it, but because a human brain under financial stress made a predictable sequence of bad decisions. You think the problem is the market. The problem is actually you. Or more precisely, it's a portfolio size that places you in a stress zone where behavioral errors become almost mathematically inevitable. There is research suggesting the psychological security threshold, the portfolio size at which people stop making fear-based financial decisions during market downturns, is approximately $1,250,000 for the average American household. Below that threshold, people feel financially close enough to catastrophe to react. Above it, they feel secure enough to hold. $500,000 is not slightly below that threshold. it is less than half of it. And here's the compounding mechanism I want to make explicit, because this is the chain reaction that transforms a manageable problem into a structural collapse. The sequence of returns problem creates a cash flow crisis. The cash flow crisis, combined with a healthcare cost burden the portfolio wasn't sized to absorb, triggers a specific decision: early Social Security claiming. The difference in lifetime Social Security benefits between claiming at 62 versus waiting until 70 is roughly $168,000 for the average American. Using 2025 actuarial data, $168,000. That is a third of your entire $500,000 retirement portfolio in the form of guaranteed income you leave on the table by claiming at 62 instead of 70. But here's the trap. When your portfolio is under pressure in year one, when the market has given you a bad sequence, your healthcare costs are running above projection, and you're 3 years away from Medicare claiming Social Security early, feels rational. It feels like replacing what you lost. What you're actually doing is locking in a permanently reduced monthly benefit for the rest of your life to solve a temporary cash flow problem. The cascade looks like this. The sequence of returns problem creates cash flow pressure in years 1 through 3. The cash flow pressure, amplified by the healthcare bridge, triggers early Social Security. Early claiming permanently reduces the guaranteed income floor. The reduced income floor means you draw from the portfolio at a higher rate than projected, and the accelerated portfolio draw compounds the sequence of returns damage you were already experiencing. One crack in the dam doesn't stay one crack. The water finds the other cracks. In 2008, the average early Social Security claimant, who would have otherwise waited until 70, but claimed at 62 due to financial pressure, forfeited approximately $1,700 per month in lifetime benefit per month for life. The math on that forfeiture over an average remaining lifespan from age 62 comes out to $233,000 in lost guaranteed income. Not theoretical, actuarially calculated using SSA data. That is a second retirement's worth of income, handed back to the Social Security Administration because the reservoir ran dry at the wrong moment. Let me now show you what this looks like as a real scenario with real numbers, because abstractions are useful, but specificity is what actually changes behavior. Two versions of Gary's retirement. Both start with $500,000 at age 62. Version 1. Gary follows the standard HR booklet. He withdraws $20,000 a year, 4%. He stays in a 60-40 portfolio. He claims Social Security at 62, receiving $1,248 per month, which is the average reduced benefit at that age in 2025, according to SSA published data. His total annual income works out to approximately $36,000. He owns his house in Ohio with no mortgage. His healthcare cost in year one on a bronze marketplace plan in his county runs $11,200 in premiums, plus $4,600 in out-of-pocket costs, $15,800 total. He budgeted $9,000. The overage eats into the portfolio immediately. By year 3, Gary has drawn down $62,000 more than he projected. His portfolio is at $438,000. The market is flat in that period. Not bad flat. And he's already off his model by 12%. Version 2. We apply what the data actually says. Gary withdraws $16,500 per year at 3.3%. He uses marketplace subsidy optimization, managing his modified adjusted gross income below 400% of the federal poverty level through a combination of Roth conversion strategy and deferred income recognition to reduce his effective premium by roughly 40%. This is a documented legal technique available to any early retiree who plans for it in the 2 to 3 years before exit. He delays Social Security until 67, his full retirement age, funding the 5-year bridge through controlled portfolio draws and $12,000 per year from a part-time consulting arrangement. He lines up 6 months before retiring. His monthly benefit at 67 is $1,785. By age 75, the difference between version 1 and version 2 is not incremental. Version 1, Gary has a portfolio worth approximately $240,000, and Social Security income of about $14,976 per year. Version 2, Gary has a portfolio worth approximately $390,000 and Social Security income of approximately $21,420 annually. The net position difference at 75, same starting balance, same market returns, is approximately $225,000. The difference is not luck. It's not superior market performance. It's sequencing, withdrawal rate discipline, healthcare subsidy strategy, and Social Security timing. Those are decisions made before retirement, not outcomes experienced during it. The reservoir held because Gary version 2 Gary checked the dam before the first summer. Now here's an angle on this that I've never seen addressed directly, and it connects to something I've watched play out across a decade of paying attention to how successful people actually manage money at this level. A $500,000 retirement portfolio doesn't create financial fragility. It creates a specific psychological trap that produces financial fragility. Here's what I mean. When your portfolio is at $500,000, you are psychologically close enough to rich to act like you've made it. Because at some earlier point in your life, $500,000 seemed like an enormous sum. But you're far enough from genuine financial security that your brain is running low-grade threat assessments in the background at all times. This combination produces a specific, documented behavior pattern. You underinvest in things that compound positively: health maintenance, tax optimization, professional guidance, and you overinvest in security theater, excess cash holdings, overly conservative asset allocation, avoiding any investment risk that might reduce the number on the screen. Research from the Journal of Financial Planning found that retirees with portfolios between $400,000 and $750,000 held on average 19% more in cash and short-term instruments than was mathematically optimal for their age and time horizon. 19% of $500,000 is $95,000 sitting in accounts earning 3.5%, when it could be in a diversified equity portfolio earning historically 7 to 8%. Over 20 years, the drag from that excess cash position costs approximately $240,000 in foregone compounding. Not from bad investments, from the psychological need to feel like you won't lose the money. The reservoir metaphor closes the loop here. People with $500,000 reservoirs spend enormous energy protecting the water they have, rather than optimizing the system the water is flowing through. They stop filling, slow the drain, and then surround the reservoir with so much protective infrastructure that the whole system becomes rigid, incapable of adapting when the drought hits or the temperature changes. Check the dam means something different from build a bigger wall around the dam. Checking means understanding the physics. Walling means hiding from them. Gary, by the way, ends up okay. Not because his plan was perfect when he started, it wasn't anywhere close. But Gary, 8 months into an exit that arrived 3 months earlier than planned and with $30,000 less than projected, sat down with a fee-only fiduciary advisor who charged him a flat $2,500, not a percentage of his assets, a flat fee. They modeled his healthcare costs correctly. They built the Social Security bridge to 67. They restructured his portfolio draw to protect against sequence risk in the first 3 years. Gary's reservoir still has water in it at 71. He checks the dam every quarter now. That is a habit he did not have before. Let me give you the 3 things that actually move the needle on this, calibrated specifically to the $500,000 scenario, because the practical takeaways matter as much as the diagnosis. First, recalibrate your withdrawal rate before your retirement date, not after. 3.3% is not a pessimistic estimate. It's the number that gives you a 90% survival probability across a 30-year horizon in today's rate and valuation environment, per Morningstar's updated research. If your plan works at 3.3, retire. If it requires 4% to be viable, you know your real target. Adjusting your withdrawal assumption by less than 1 percentage point either confirms your readiness or tells you exactly how much more you need. That is more useful information than any retirement calculator that assumes the rate you want rather than the rate the data supports. Second, model the healthcare bridge as an obligation, not a percentage. Not Healthcare is maybe 10% of my budget. As an actual dollar amount in your actual county on the actual marketplace plan you would use, with your actual health profile, the Kaiser Family Foundation publishes a free subsidy estimator that gives you a reasonably accurate figure. Run it. Subtract it from your retirement capital before calculating anything else. That is money that is already spent. Your investable portfolio is what remains after that obligation is accounted for. Third, never make your Social Security claiming decision under financial pressure. This means building enough liquidity and income bridge into your pre-Medicare years that you are never in a position where claiming early feels like survival. The mathematical cost of claiming at 62 versus 70 for someone who lives to 85 is approximately $78,240 in additional lifetime income, foregone at average 2025 benefit levels. The Social Security Administration does not issue refunds for early claiming decisions. The decision is permanent. The pressure that drives it is often temporary. The gap between those two facts is where an enormous amount of retirement wealth disappears. Lazy investing built more fortune than crypto memes. The standard advice: max your 401k, target 500,000, follow the 4% rule, retire at 65, is a complete sentence that omits the most important words. It's like a recipe that lists the ingredients but doesn't mention oven temperature or the order of operations. The dish might turn out fine. Or you might open the oven in year 23 and find nothing in there. $500,000 is a real achievement. It is not a guarantee. The gap between achievement and guarantee is filled with sequence risk, healthcare costs, behavioral spirals, and Social Security timing decisions that most retirement calculators aren't built to model and most advisors aren't incentivized to explain. Check the